Insurer AXA Pacific has size, it's got scale, and it's got a prominent brand. It's even got a natural floor under its share price thanks to its French parent. The one thing it hasn't got these days is fund inflows. To tell us more, we have Morningstar Senior Equities Analyst David Walker. David, welcome back.
Thank you, Vicky.
First of all, David, can you give us a bit of a rundown on how AXA makes its money?
AXA is a major trans-Tasman and Hong Kong life insurer and wealth manager with smaller operations in China, India and Southeast Asia. It offers the traditional range of life insurance policies and a suite of modern wealth management products. AXA makes its money by charging more in premiums than it pays in claims and by taking a percentage of its funds under management and administration.
So how has AXA come out of the global financial crisis?
Well, AXA was hit hard by the GFC. Earnings crashed from a $645 million profit in 2007 to a $117 million loss in 2008, mainly due to negative investment returns on the company's policyholder and shareholder portfolios. The result would have been worse if not for the depreciation of the Australian dollar, an acquisition in Hong Kong, and lower than expected life insurance claims in Australia. Australian wealth management earnings fell 27%. Then in the first half of 2009, the result bounced back as markets rallied.
In terms of capital management, how would you rate AXA?
Well, AXA's capital management during the crisis disappointed. As markets plummeted to new lows early this year, the company was caught with too much debt and excessive exposure to equities. On the 18th of March, 2 weeks after the market bottomed, AXA raised $500 million of new equity at $2.85 per share after the stock peaked at $8.16 in October 2007. It raised another $166 million in equity a few weeks later during a share purchase plan. Then, at exactly the wrong time, the company renewed its derivative protection against falling equity markets. AXA sold call options over its European, US and Hong Kong equity portfolios, and although that was well intentioned to guard against further falls on the markets, it does cap shareholders' upside from the global market rally, and this will be seen in lower second half investment income. Now, no one expects management to consistently time the market, but we did expect more from a major investment institution and a highly paid management team than dilution of this order of magnitude.
We've seen some clear signs of confidence returning to the stock market. Now, is this going to help fund inflows for this company?
Well, net inflows will recover with the markets, but it will take time. Probably another 6 to 9 months for net inflows in Australia and New Zealand to return to what might be called normal levels, and longer still for them to surpass previous peaks. By the end of the June quarter, markets had rallied for nearly the whole 3 months. But substitution from AXA's cash funds back to its equity funds had only just begun.
David, overall, what you've described is a bit of a mixed bag. Are there any signs of encouragement on the horizon for AXA?
Earnings will automatically recover with the markets because rising markets inflate funds under management and administration, and therefore investment management fees, which are a fixed percentage of those fund balances. Additionally, the investment returns on AXA's shareholder and policyholder portfolios will recover with the markets. Net inflows will recover in time, and there's always the potential for a second takeover bid from AXA's French parent, which recently increased its holding from 53% to 54%.
Overall, what can investors take away from this today?
Investors need to understand AXA is a share market cyclical with currency exposure as well. For example, since the markets bottomed in early March, AXA has rallied with the markets but has underperformed AMP because the Australian dollar has appreciated against the Hong Kong dollar, reducing the translation into Australian dollars of Hong Kong earnings. Other risks are policy renewal rates, new business levels, claims experience, and adverse regulatory potential reforms arising from the Cooper review of superannuation fees. And once again, there's always the potential for takeover upside if the French parent, AXA SA, decides it wants to take out the minorities in the business.
David, thank you for your time.
My pleasure, Vicky.